Traders. We continue with our series of 2024 USDJPY mentorship, and I want us to look at how to trade economic data. Key concept that we'll cover in this lesson, we look at what is fundamental analysis. We look at the importance of fundamental analysis. I will look at the most volatile economic events, and also how to trade the economic events. So when we talk about fundamental analysis, this involves evaluating and analyzing various economic, political, and social factors that influence the value of a currency. So unlike the technical analysis, which focuses on historical price movements and chart patterns, fundamental analysis looks at the underlying factors that drive the supply and demand of a currency. So we have different Forex calendars or economic calendars. You can be able to see these fundamentals that are listed, especially the economic events. And the best one that I like using is the forexfactory.com, but also the others you can also use in Investopedia. You can be able to see different. We have different places that can be able to view this data. But like I said, Forex Factory is the best for me. Because of different reasons. So social factors and some political factors will not be listed in the economic calendar since they happen when least expected. So these are like, especially the social factors, they are natural calamities. Okay, like for instance, when we had a war between Israel and Palestine, so no one knew that it was about to erupt, but they just erupted significantly, and these affected the market. We saw gold skyrocket from around 1932, and it went all the way to create all new time high. Political events, like when we have a major presidential election, like in the United States of America, you find that the major currency pairs, that is those pairs that are paired in the dollar, are greatly affected. So this is how the Forex Factory looks like. The reason why I like the Forex Factory is because I can be able to filter different types of news. So I like looking at the bank holiday so that I can know which pairs or which currencies maybe don't have much economic event during that day. Because when you have bank holiday, it means that the currency, the movement of the currency or the transactions in the currency are basically low. So these are the time that we find this currency basically consolidating. So I also like looking at the high impact news, and these are the ones that in the red boxes. And these are news that actually have high impact at the market. I also like the Forex Factory, the fact that I can be able to adjust according to my time frame or my time zone. So I'm able to know what event to expect when and during what particular time. So we shall look more in details probably in the Forex Factory. I'll take you through how to do the settings. But before that, the importance of fundamental analysis. Why is it important for Forex traders to do fundamental analysis? Number one, it's because for long-term trends, you can be able to do fundamental analysis for long-term trends. That is, it enables us to be able to look at the market and be able to predict or come up with ideas on how the market is likely to play out in the long term. Okay, so fundamental analysis is particularly valuable for identifying long-term trends in currency values. So such economic indicators, central bank policies, and other fundamental factors can provide insights into the underlying strength or weakness of a currency over an extended period of time. So the other reason is market direction. So it is important for us as traders to know which direction the market is. And fundamental analysis basically helps traders to understand the overall direction of a currency pair. So by evaluating the economic health and prospects of the countries involved, find that traders can make informed decisions about whether to go long, that is to buy, or to go short, which means to sell a particular currency. So also another importance, it's events-driven trading. And with events-driven trading, whereby these economic events such as the central bank announcement, um, data release, and political developments can cause significant volatility in the Forex market. So fundamental analysis here helps traders to anticipate and respond to these events, allowing them to take advantage of potential price movements. Okay, so this is when you're trading these fundamentals in the short term. So once the events are being released, you take advantage of the volatility, you get into the market and get a few pips here and there. Okay, so the other key reason or importance is risk management. So understanding the fundamental factors influencing currency values help traders manage risk more effectively. By staying informed about economic conditions, interest rates changes, and geopolitical events, traders can better assess the potential impact on their positions and adjust their risk management strategies accordingly. So when we have high risk, it's best to ensure that you manage, when you have high volatility, it's best to ensure that you manage your risk accordingly, so as to cater for the volatility. Then the other reason or importance is global economic outlook. And here you need to understand that Forex markets are interconnected with the global economy. So fundamental analysis allows traders to access the broader economic environment, providing insights into the overall health of the world economy and potential implication of currency values. Okay, so the other key reason is or importance is the interest rate differential. And with the interest rate differential, it's good to understand that interest rates actually plays a significant role in currency valuation. And with fundamental analysis, this helps traders monitor the central bank policies and the interest rates differentials, which can influence and carry trade strategies and impact currency pairs. Okay, so we have the most volatile economic events, and this does not mean these are the only events that are volatile, or they are the only economic events that we have. We have a couple of them. We can have the GDP, that is the gross domestic product, as many as possible. We have several of them. But what I have tried to list here is the most volatile events that basically move the market a lot. And the first one, we have the interest rates, we have the inflation, and also we have the employment outlook. So with the interest rates, it's good to understand how these interest rates affect the market or the currency. And we said that interest rates significantly impact the Forex market by influencing currency values. And you also need to understand that the central banks adjust the interest rates to control inflation and stimulate economic growth. So higher interest rates attract foreign capital seeking better returns, strengthening the currency. Conversely, lower interest rates encourage borrowing and spending, which weakens the currency. So traders, or we as traders, we tend to closely monitor the rate's decision, as expectation or surprises can lead to swift market reactions. So interest rates differentials between countries also affect the currency exchange rate, impacting the investment decision. So this is when you're trading you're trading in the long term. So overall interest rates dynamics serve as crucial factor in determining the strength and direction of currencies in the Forex market. Okay, so when you're talking about the interest rates, this is where I want you to understand that this is a key significant factor, because people always ask, or you have heard about the market makers, and I want to bring to your attention that the central banks, they are the producers of the currency price, and therefore they are the market makers. Okay, so this is because the central banks establish and manage a country's currency price at all times, both autonomously and manually. So the reason why we say that the central banks are the market makers. Okay, so the other economic event that you need to understand is inflation. And inflation profoundly influences the forex market as it reflects a country's economic health. So rising inflation erodes purchasing power, prompting central banks to raise interest rates in order to curb inflation. So higher rates attract foreign capital, strengthening the currency. Conversely, low inflation may lead to lower interest rates, weakening the currency. So traders closely monitor inflation data as it signals potential central bank actions and impacts currency values. So inflation differentials between countries also influence the exchange rate, shaping investment decisions. Ultimately, you need to understand that inflation's impact on a nation's economy stability plays a pivotal role in determining currency strength or weaknesses in the forex market. And the reason why you find that in the economic calendar, the inflation data will always come first. Okay, so once the inflation data has been released, like this week we have a couple of inflation data, and this inflation data is measured as a CPI. It's measured as CPI in the forex calendar. So in the forex calendar, you'll find the inflation data as CPI. Okay, so once it is released, then now it is all of this data that there is a formulation. Now the central banks come into place, try to digest the data, and therefore it gives them, or it lays the basis of their decision in terms of interest rates, whether to increase the interest rates, whether to decrease the interest rates, or whether to maintain the interest rates at par. Okay, so we have the employment outlook also, which is a very significant data. And the employment outlook significantly influences the forex market by serving as a key economic indicator. So positive employment data such as low unemployment rates and robust job creation signals economic strength. This often leads to increased consumer spending and overall economic growth, strengthening the domestic currency. Conversely, high unemployment or weak job numbers can weaken a currency as it suggests economic challenges. So as traders now, we want to closely analyze the employment reports for insights into a country's economic health, impacting their forex decision. Employment outlook serves as a crucial factor in determining the perceived stability and attractiveness of a nation's currency in the global market. Okay, so it is as straight as it is, and that's how you try to interpret this type of data. So the other thing that we need to look at is how to trade economic events. These events that we have talked about, and even the ones that we have not talked about, they can be traded in two broad ways. Number one, that is short-term trading, and also number two, long-term trading, especially when you're looking at the interest rate differentials or the inflation differentials. So short-term trading means that this is where once the news are being released, exactly at that particular time, you go into the market, you wait for the data to be released, you interpret the data, and you take advantage of the volatility at that time. And this is basically what I can call scalping. So you scalp the movement of that, the volatility that has been caused by the news release. So you get yourself like maybe 20, 30 pips, or even 50 pips, or even 100 pips, because some of these data are very volatile. They can give even up to 200 pips, depending on how strong the data is. Then we have the long-term trading, and with the long-term trading, this is whereby we look at the interest rates differentials. Okay, and the reason why we want to understand the interest rates differentials is for us to know what direction or what is the present condition of the market. Is it bullish or is it bearish? Okay, so this is when we are aligning ourselves in the market. Will the data cause a bullish market, or will the data cause a bearish market? Okay, so, and where to find this information? The interest rates differential, you can get it in globalrates.com. I have given you the link there. That is where the interest rates differentials are listed from the different central banks. Okay, so once now you have this information, the key thing is how to formulate, okay, or the formulation of your analysis. How do you plan your buy program, or how do you plan your sell program? Okay, so the reason why I'm saying now, for you to be able to plan, to interpret these interest rate differentials, and you plan for your trades, maybe a buy program or a sell program, it is best to pair a stronger currency with a weaker currency. And the rule of thumb has been when the base currency is stronger than the quote currency, we will be looking to buy. So when you pair a quote a currency that has which the base currency is stronger than the quote currency, then for that currency pair we shall be looking to buy. When we have a currency pair whereby the quote currency is stronger than the base currency, then we shall be looking to sell. So in other words, what we are saying is that we need to pair a stronger currency, that is a currency with higher interest rates, as the base currency with a weaker currency, that is the currency with the low interest rates, as the quote currency, which will give us a bullish or a buy program. So if you pair the weaker currency, that is the currency with the low interest rates, as the base currency with a stronger currency, that is a currency with higher interest rates, as the quote currency, this gives us a bearish or a sell program, right? So I want us to go to the interest rates differential, the website for interest rates differential. So once you click the link that I've shared, you'll be able to see the interest rates differential. It will take you to this website. And this is the information from the different central banks. So you can see the American central bank, that is the Federal Reserve, the Australian central bank. We have a couple of central banks where the data, the interest rate differential is given. So we have the previous, we have the current, and we have the change. Remember, this is long term, and the reason why you'll find that the change at times, it was sometimes back ago, like you can see for the Japanese central bank, the last change was in 2016, right? The last change was in 2016. So when you are saying that we need to pair a weaker currency, that is a currency with low interest rates, and we pair it with a stronger currency, that is a currency with higher interest rates. For instance, let's take the American central bank. So the United States, that is the United States. So the interest rates by the Central Bank of America, that's the Federal Reserve, is 5.0%. Okay, so we can maybe look at a currency that has low interest rates, especially the one that has negative interest rates. Let's look at the Japanese yen. It has negative interest rates, that is negative 0.1%. Okay, negative 0.1%. So we can pair these and come up with a pair like USDJPY. Okay, so let's look at the USDJPY chart. So this is the USDJPY chart, and like we have seen from the central bank interest rate differentials, we have seen that the USD has a high interest rate, 5.5%, and Japanese yen has a negative interest rate of negative 0.1%. So when we are pairing this currency pair, it means that the USD is the base currency, which is stronger than JPY, which is the quote currency, and this gives us a buy program. Okay, this gives us a buy program. So like you can see, since around February 2012, USD has been in a bullish momentum. Okay, it has been in a bullish momentum. This was just a retracement because, again, you know that the market moves in fractals. Okay, the market moves in the fractals. It pushes up, then retraces, then continues to push up strongly. So can see in the long term now, as a trader, I'm able to know that from the monthly time frame or from the higher time frame, USDJPY is in a bullish momentum. So especially those traders or investors that would like to invest in USDJPY, or those that take trade positions, take positions for longer time, that is position traders. They can run a position maybe for a couple of months. They can take even one position and run it for a year. So this interest rate differential information becomes very useful in trying to look for a pair that you can be able to trade in the long term. Okay, so this is where now the category of investors comes into place. So for me, I am a short-term trader, so I don't have the patience to hold a trade for a year or for a month in that manner. So I just like entering in the market. Like today, I make whatever I'm gonna make, and then I exit the market. But find there are other traders who this information is very, very much useful for them in terms of trying to look at the currency pair which they can be able to invest in the long term. But again, even as a day trader, this information again is very crucial, because at the back of the mind, it gives you a bigger picture of exactly whether we are in a buy program or we are in a sell program. So before we wind up, let me share the Forex Factory. So this is the Forex Factory, like you can see. And this is where you look at different economic events that are listed that we are anticipating. And like you can see, this week we are anticipating the CPI data from various countries. So we have, yesterday we had the CPI, or the inflation data for CHF. Tomorrow we'll have the inflation data for AUD. We'll have on Thursday inflation data for USD. And on Friday, we shall also have the inflation data for China and also USD. This PPI basically is also another parameter that is used to measure inflation. So I believe this information is useful. You found this information useful. So that's how we align ourselves fundamentally, or that's how we do the quantitative analysis in order to try to get to understand how these events are going to affect the market, and therefore we are able to align ourselves accordingly as traders to know whether we are in a buy program or we in a sell program, and therefore we are able to take positions accordingly. So thank you so much, and let's meet in the next mentorship.